This last week just set the tone of what lies ahead for the future of the housing market. We saw mortgage rates hit new record highs, inflation numbers came back worse than expected, the 10-year treasury hit over 4% for the first time in over a decade, and in addition to all that, we continue to see buyer demand plummet. So what this means in a nutshell is essentially the housing market is about to experience pain on another level right now, and we've been talking about this for the past few weeks about how this housing market is entering into the second phase of this housing market correction. So in today's video, we're going to talk about what the current state of the housing market looks like and how it's going to look as we start to enter into 2023 in the months ahead. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. The housing market is heading towards a bigger correction. You see, the more data we get back and the more updated information we receive, the more it just confirms that we are headed towards more pain as far as the housing market is concerned. Now, understand that this is a completely different crisis we're experiencing right now compared to 2008. Back in 2008, the problem then was bad lending practices. Now, we are not experiencing that in today's housing market, at least as of yet. The real problem we're facing in today's housing market really comes down to affordability, what you can afford to pay on a monthly basis for your house. You see, right now, if you were to take, say, a $410,000 house, put 5% down at today's mortgage rates, you'd be looking at a monthly payment of $2,633 a month. Now get this, even if you kept that same exact price but simply changed the mortgage rates just to where they were at last year, that monthly payment would go all the way down to $1,672 a month. So essentially, in just a year, just purely off of mortgage rates and keeping the same priced house, you're talking about almost doubling the monthly payment you have to pay for a house. Now, mortgage rates have continued to go up as the Federal Reserve continues to stay aggressive with its monetary policy. And when inflation data came back this past week, we saw the markets react to it as Treasury bonds continued to go up as well. Now, I personally like to look at the 10-year Treasury because it correlates very closely with mortgage rates, and what we saw this past week is we finally hit over 4% on the 10-year Treasury for the first time in over a decade. This translated essentially to mortgage rates going up to the highest levels we've seen in a long time. We're currently at 7.16% now. These are essentially the highest levels of mortgage rates we've been at in over 20 years, and it's only going to continue to go up as inflation continues to be a problem. Now that brings us to one of the biggest concerns the Federal Reserve has is core inflation continues to keep rising. We saw it go from July at 5.9% to 6.3% in August, and now for September's data, we got it back at 6.6%. Now, it's important to note that these are the highest levels of core inflation that we've experienced in the US in over 40 years. So that is a very big deal, and as we step back and look ahead to the future, as far as the total inflation picture looks, we have a lot of stumbling blocks along the way, such as student loan forgiveness, which has a $500 billion price tag that hasn't been implemented yet, and that's going to cause more inflationary pressure. We have gas prices that are bound to go up as the supply of oil continues to go down, and we have lagging statistics when it comes to the rent growth statistics the government keep. It's finally catching up to the true numbers. That's going to be a problem for the total inflation picture and core inflation for that matter as we continue to see those numbers be a problem. So because of this, we can anticipate the Fed is going to be more aggressive. There's going to be more rate hikes along the way, and we're already seeing that amongst investors, that the expectations for the future rate hikes coming up in November, there's going to be another rate hike taking place. The expectations are now set at for sure it's going to be a 0.75% increase. That's a minimum expectation. Some people are even pushing for a 1% increase. And in December, we may see another 0.75% increase, which means we could be seeing the Fed funds rate reach as high as 4.75 to 5% by the end of the year. And going into 2023, assuming inflation continues to be a problem, I wouldn't even be surprised to see us reach 6% levels. Now remember that affordability is the biggest reason why we've seen these house prices correct the way they have so far, and even these current prices really haven't corrected to where mortgage rates currently are. And Black Knight made a good point that even going back to where they were at 6.7% mortgage rates, that was the lowest housing affordability levels we've been at in over 38 years. Now we're currently at 7.16%, which is even higher than the 6.7%. And imagine when we get to 8% levels, what that is going to do to housing affordability. It's going to cripple the housing market, and house prices are going to have to give way. So as we see these mortgage rates continue to get higher and higher, the Mortgage Bankers Association tracked this metric of buyer demand of purchase applications is the metric they use, and they track it on a weekly basis. So we get very up-to-date information from the Mortgage Bankers Association. And what we saw is that we had another weekly drop of 2% week over week in purchase applications, and now we're down over 39% year over year in purchase applications. So you can actually see this chart. This is a great indicator of buying demand continuing to plummet, and you can see based on this chart that we're actually at the lowest levels really since 2015 at this point. Now at the same time that we're seeing buyer demand plummet, we are continuing to also see new listings decline, which has been one of the major talking points that I've been going over these past few weeks, is new listings versus buyer demand both going down, both having opposite effects on the market. So this is a great representation of buyers versus sellers, and what we're seeing is that buyers really just don't have the means to afford housing anymore. Like we talked about, the lowest levels of affordability in over 38 years. So they're priced out of the market. Sellers don't want to sell because they know they're priced out of the market, so there's very weak demand to buy houses right now. But in addition to that, they don't want to sell because over 85% of owners with mortgages are locked into mortgages with under 5% interest rates, many of them under 3%, 4% rates as well. So why do you want to sell, buy another house with a 7% mortgage rate? And so what this causes is for housing transactions as a whole to plummet altogether, as we're continuing to see homes sold go down and pending sales go down. Now pending sales is really interesting to look at. It's a little bit more updated information to look at, as it's really a glimpse into the future of what home sales is going to look like. And we saw pending sales down over 28.1% year over year. That was a drop from last week as well. And in addition to that, we're really at the lowest levels really since a 3-week period at the beginning of the pandemic, when everyone dropped out in March when that took place. We're also seeing a drop in the amount of homes sold above list price. And what we're seeing is we're down to only 30% of homes are selling above list price, which is the lowest level since the early days of the pandemic. So this obviously comes down to less competition in the market at this point. And as we're seeing that happen, homes are sitting on the market longer. We've seen them go up. The median days on market is now up to 33 days on market, which is up another day from last week. And that continues to go up. If you look at this chart, you'll see the weekly trend. It continues to go up another day about every single week. And we've come all the way from about 16 days on market. Now we're at more than double that at 33. Now, naturally, this has also led to more price drops as homes sit on the market longer. Home sellers get desperate to sell their house, so they start to lower their price. And so we've seen that increase to the highest levels during this cycle, currently at 7.9% on the weekly levels, which is about 31.6% of all inventory across the nation has experienced a price drop of some kind. Now, despite the price drops going up and homes sitting on the market longer, the home prices are actually stabilizing as of the last few weeks. So why is that? Well, the answer to that question is lagging data. When you're talking about homes sold and the prices they're selling at, you're talking about homes that were listed on the market a couple months ago. And so if you had a home that sold in September, you have to go back to July is when those homes were probably listed on the market. And so where were interest rates at that point? Well, they were hovering around the 5% levels. That's 2% less than where they're currently at now. And that has a huge impact on affordability and what the monthly mortgage payment would be. Now, when you look at Redfin's data, they look at a 4-week period. So you're not looking at just even October, taking it back to August, but you're looking at a period from September 9th, or really September 11th, up to October 9th. And that whole entire period is based on the homes that were probably listed on the market for the most part back in July and August. So this is ultimately why I'm not paying too much attention right now to the median sales price, because it's really lagging what the accurate data is going to show in the coming months ahead. And I think that November is really the month we want to pay attention to when we start getting that data for September and October. Now, with that said, it is actually interesting that despite what I'm talking talking about, there are some markets that are still moving downward, even while the rest of the nation on average is stabilizing. For instance, Austin, Texas has been hit really hard in particular. We saw them at a high of $574,000 at the peak. Now we're all the way down to $476,000, almost $100,000 less. That's over a 17% price drop from peak levels. Another example is Seattle, Washington. If you look at Seattle, Washington, you can see it's still continuing to trend downward. We were at a high of $852,000 back in May to June time. Now we're all the way down to $761,000, over a 10% price drop. Now, the third market that stuck out to me that's continuing to go down while the rest of the nation stays put is Sacramento. Now, Sacramento was as high as $614,000. Now it's down about 9.6%, all the way to $555,000. So I'd keep an eye on these markets, because if it's continuing to go down at this rate, how's it going to react when it reaches levels of over 7%? Now, regardless of that, I do anticipate the rest of the nation will follow suit, especially as they catch up to where mortgage rates are currently at, and that's going to cause more price declines to take place. But looking ahead into 2023, I do anticipate that inflation will continue to be a problem because of what I mentioned before. The Federal Reserve will in turn have to be more aggressive than they've been so far, and as a result, mortgage rates are going to go up. We're going to see them reach probably over 8% in my estimation, and that's going to cause housing affordability to continue to plummet. Now, a famous rule of thumb is that for every increase of 1% in mortgage rate, you see a 10% decrease in buying power. So it makes it less affordable, of course, the higher the mortgage rate is. Now, we've seen it go from 5% levels in August. If we take it all the way up to 8% levels, that is a 3% increase, which means that we're looking at a 30% decrease in buying power. But this isn't just about mortgage rates, because buying demand will also go down when we enter an economic recession, which is going to happen because as the Fed raises interest rates and continues to be aggressive with its monetary policy, what we're going to see is that companies' revenues are going to get hit as less people borrow money, as less people spend money, and so as a result, we're also going to see unemployment levels start to go up. All of this is going to contribute to less buying demand in the housing market, and ultimately will lead to more price declines in the ways what I expect to happen in 2023. Now, we're already beginning to see that retail sales are starting to slow down a bit. We got the latest numbers back this last week, and the growth was completely flat. We saw 0% growth year over year for retail sales. The expectation was for it to see a 0.2% growth, so that was definitely lower than expectations. Now, we're going to need to continue to see these numbers go down in order to beat inflation, because the less consumer spending that takes place, the less demand there is for these goods and services, and so prices are forced to go down as a result. So this was good news overall, especially when you start to consider that these numbers were not even adjusted for inflation. Now, remember that inflation month over month was actually up 0.4%. So that's the cost of goods and services was up 0.4%, but retail sales was flat at 0%. So overall, what we're seeing is that retail sales is actually starting to slowly retreat. So this was a sign that the Fed rate hikes are starting to have an effect on consumer spending, but the Fed knows that they're going to need to keep stepping it up if they're truly going to tackle inflation and avoid this being a long-term depression. So overall, I think it's pretty much an expectation at this point that house prices are going to go down further. But with that said, the thing is how long or how short is this correction going to take place? The sooner we can get through this recession, the sooner we can get back to the good times again. So with that said, I hope you guys enjoyed today's video and you gained some value from it. I'm going to continue to keep you posted on the latest updates with the housing market. And if you gained some value from today's video, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below if you have any questions or thoughts, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out-of-State Investor. And if you guys enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.